Hey, what's up guys? Aaron here, and in this video I'm going to be listening to the Fahrenheit spaces that came out yesterday or so on the 19th. I will be listening to it in normal speed, so if you want to do a 1.5x on this video, it may be nice if you just want to get through it. So Fahrenheit, again, is doing a Twitter Spaces, or did a Twitter Space with the Celsius UCC and also the debtor, meaning Celsius, and just going over a lot of different questions. A lot of people had a lot of questions going into this, and we will just go from there. So let's go ahead and get started.
My name is Kelly Callahan. I'm partner at Arrington Capital. We're also part of the Fahrenheit team. We have here the Fahrenheit team members plus representatives from both the creditors and the debtors and the UCC. There's a couple handles that have been speakers. We have over 300 questions that have been submitted from the community from numerous languages and from around the world. We have consolidated those, and our attempt here today is to get through as many as we possibly can and hopefully have time for a few additional questions within the hour. The topics that we're going to be covering include why we're here, why this team is doing it. We will give you an update on the plan process. We had a number of questions on liquid crypto distribution, the assets that are going to be in NewCo, the convenience class, Bitcoin mining, ETH staking, some of the venture and illiquid assets, the equity listing, voting timelines, regulatory, tax, and governance. So there's quite a number of things to get through. So we appreciate everyone coming on time and diving right into it. Andrew Carty, you've been made a speaker. Could you come on and just do a quick disclaimer for us?
Yeah, thanks, Kelly. Hopefully everyone can hear me. This is Andrew Carty from Brown Rudnick, counsel to Fahrenheit. Before I hand it over to Steve Kokinos, the proposed CEO for NewCo, I'm going to kick things off with, I think, everybody's favorite topic, which is legal disclaimers. As Kelly said, we're going to do our best to answer as many questions as we can, but we're in a bit of a sensitive time in the process. We have a plan on file, we have a disclosure statement on file, but we don't yet have a court order approving the disclosure statement. And so what that means is that we can't solicit votes with respect to the plan. And so I want to make clear at the outset that this discussion is not a solicitation of acceptances with respect to the plan. Any such solicitation will occur only to the extent that the disclosure statement is approved by the bankruptcy court, and the plan and the disclosure statement are then distributed out to creditors. Finally, the discussion and descriptions today are qualified in all respects by the documents themselves, by the plan and the disclosure statement. And we urge all creditors to please review those documents. We know that they're quite lengthy. We're going to do our best, again, to address what we see as sort of the most frequently asked questions, but please read the documents in their entirety. They contain the most information, the most up-to-date information as of today. So with that, I'll hand it over to Steve to introduce the team and get things kicked off.
Thanks, Andrew. Well, I guess just to start, on behalf of everyone from Fahrenheit, we're really excited to be working on this project and focus on maximizing enterprise value for everyone. And, I think one of the interesting things about this that makes us excited as investors is that at emergence, the NewCo will be one of the scale players, not only in Bitcoin mining, but also in Ethereum staking by staking balance sheet assets. And will really be one of the first public companies that has exposure to both of those assets. And
so they start out right by saying that this will be one of the biggest, or possibly one of the biggest and best Bitcoin mining companies, and also a publicly traded company that has exposure to Ethereum staking, which I don't know if there is another publicly traded company that has that kind of exposure. If there is, let me know in the comments. But that is an interesting proposition. And again, our equity would, hopefully other people would want to buy it for more money, right? That's the point. So we would get, more money for that equity and we'd be made whole. So if this is a revolutionary new type of company, especially leading into most likely another bull market, the halving next year, and then leading into the bull market 2024, 2025, then this could be something that could provide a lot of recovery for us.
so we think will likely be of interest to institutional investors. I think the other part that I wanted to really make sure to highlight up front, as you're going to hear from all of us today, is that each of the principals in the Fahrenheit team bring really unique experience, and experience not only in their relative domain areas, but experience operating at scale, that we feel is really critical to the success of NewCo upon emergence. And just to walk through, Asher Ganut, who is one of the founders of US Bitcoin. US Bitcoin has really done a lot of work to grow into not only the most one of the more substantial Bitcoin mining companies, but also really doing that in an operationally efficient way. And I think when Asher gets into the details of exactly what is being provided to NewCo, I think that'll be very, very clear to everyone here as well. Noah is the principal of Proof Group, which is a crypto-focused VC, but also runs several $100 million of Ethereum staking and proprietary software they've created is going to be a core part of the staking business at NewCo as well. Ravi Kaza is a longtime hedge fund manager and has deep experience in both public and private equities and liquid trading, and so I think very instrumental, especially around risk management in the business here. And last but certainly not least is Michael Arrington, who's the founder of Arrington Capital, and as many of you know, prior to that was the founder of TechCrunch and has invested in many of the most significant projects in the crypto space, and I think will be instrumental in managing some of the illiquid assets that are being transferred to NewCo upon emergence. And
So, yeah, basically Steve Kokonos, who's going to be the CEO of Fahrenheit if this goes through, he's basically laying out the team. So there is a team of competent miners, stakers, venture capitalists, and also he mentioned Michael Arrington that he thinks will be competent in the illiquid side of the NewCo or illiquid assets. So, I mean, he is laying out a good team here. We'll continue to listen to see what they say.
Mike, I know you had a few things you wanted to say, so maybe I'll just turn it over to you.
Yeah, thanks. So this is Mike Arrington from Arrington Capital. I want to set the tone for today, and this is a message that we have given to creditors, the committees from the very beginning, but we haven't had as much of an opportunity to talk publicly about it. But we know that many or all of you were very hurt by Celsius. We know that you live all over the world and that several of you had your life savings in that company. We know that many of you had loans that were liquidated and collateral was lost. We know that assets were sold along the way at different points that you didn't want to happen. And we know that for many of you, this has been the worst experience you've ever gone through in your life. We are sorry that you have been and continue to go through this. And remember that all of us are players in crypto, and we have been through significant situations like this ourselves. We didn't have money in Celsius, but we have lost money, including personal money, in other situations, and we understand how tough last year was. We truly do. We believe there is serious potential with Celsius. And given how institutions are now finally stepping into this space, we believe the future has even more potential. The difference between our plan and the plan from when we entered the process is stark. Hundreds of millions of dollars in difference. And we'll go through those differences today in detail. Our plan is intended to maximize value and recovery for all of you. It will take some time, but we're very much believe in NewCo. We're investing our own money, substantial amounts of our own capital in NewCo, and we will do our best to bring this to success.
Thanks, Mike. We also have on the line today, before we dive into all those questions, Chris Ferraro, Interim Celsius CEO. Chris, do you want to come on and just share a few thoughts before we dive in here?
Yeah, hi, everybody. Hopefully you can hear me okay.
Yeah.
One of the things I wanted to touch on was the difference in the disclosure statement between the liquid crypto distribution with the Fahrenheit NewCo plan and the orderly wind down. Just to level set and give some background here, there's an additional 500 million of liquid crypto under the orderly wind down that is not held back to capitalize NewCo. However, there's approximately 250 million of incremental expenses to effectuate the orderly wind down. This all results in a net 250 million of additional liquid crypto to initially distribute in the orderly wind down compared to the NewCo plan.
So let me just stop that right there. So what he said is that between Fahrenheit and the orderly wind down, us creditors would get right now with the current orderly wind down, which again, there will be new bidders by the end of this month. Creditors will get $250 million more with the wind down, but then there would not be this Fahrenheit company, this business that could potentially do very well. So that's what he's saying right now.
Keep in mind, under the NewCo plan, a total recovery of 69.7% in liquid crypto and common stock is expected to be part of the initial distribution, of which the common stock is expected to be available to monetize immediately if desired. Under an orderly wind down, it may take months or even years to receive the remaining 18.6% recovery, for a total estimated recovery of 60.8% in the orderly wind down, or about 8.9% lower overall recovery compared to the NewCo plan. And then Kelly, if I may, I think there was one other question kind of about the success of the auction.
So what Chris Ferrara was saying is, he's trying to pitch this NewCo very, very hard. He's trying to encourage people that, this is a better idea than the orderly wind down. Now, I know that Simon Dixon in his latest Twitter space or actually YouTube video, he really broke it down very, very well. He had his team go through the financials and the differences between the orderly wind down and also Fahrenheit. And there are still some things that are a little bit uncertain. If we can get a better orderly wind down structure where we pay less in fees, I think it could make more sense to do that. Right now, though, I personally am still a little bit up in the air regarding what would make the most sense. You and I, we don't really have a say in this because if we vote no on the plan and the plan gets denied, then we're probably going to go to Chapter 7 or we're going to go back to the drawing board and get new bidders literally starting from day one. So I don't think that's the right decision, but I will keep you guys posted on what is happening in that realm.
Yeah, I'll jump into that. As you all remember, the auction process was a continuation of a sales and marketing process that started last year. The debtors invited the 3 qualified bidders, NovaWolf, Fahrenheit, and the Brick, to the auction. After an extensive process that lasted nearly 4 weeks, the auction concluded on May 24th. As you know, the debtors, in consultation with the committee, selected Fahrenheit as the successful bidder and Brick as the backup. By all accounts, the auction was a success. All told, compared to the NovaWolf Stalking Horse bid, the improved terms of the Fahrenheit bid allows for the distribution of hundreds of millions of additional liquid crypto and reduces NewCo's management fee by hundreds of millions of dollars as well. Specifically, compared to the Stalking Horse, Fahrenheit's NewCo liquid crypto holdback was reduced by over $600 million. Similarly, the management fees are fixed, as opposed to the variable fee structure under the Stalking Horse bid, and the incentive fees are now paid entirely in equity, better aligning incentives. Beyond the considerable cost savings, the Fahrenheit team was selected because of the strength of their team and the vision for NewCo. I'll turn it over to Chris Koenig if he has any additional color on the auction.
Hi, everybody. It's Chris Koenig from Kirkland Work Council to Celsius. Just a couple of additional points. Look, the auction took a long time. We think it took too long. We wish it would have been shorter. But as Chris said, there were very significant improvements and changes that are going to benefit account holders from the auction process. And so from that perspective, it's a great success. And the best part of it is that we're now on our way to disclosure statement approval, hopefully confirmation and emergence, which means getting people their crypto back and making distributions promptly. On the auction, I think it's notable that at some point in the auction, each of the bidders was the leading bid, and they kept having to go back and forth to one-up each other and improve the terms of the plan for account holders. That's why it took such a long time for us to conclude the auction, because it was such a competitive process and because everybody kept submitting bids that improved the terms of the deal. That's why we kept the auction going, because we thought that it generated a lot of value for you all. So that's all that I have to add. Think that Chris covered the highlights of, improvements for account holders, but we're ready to move on with the process, get the plan confirmed, and make distributions and get out of bankruptcy. Thank you.
Thanks both. Appreciate those comments and the opening there. All right, so getting into the questions from the community that have been contributed and submitted over the past week or so. The first bucket are questions regarding the projected liquid crypto distribution under the current plan. I'm going to take this first question. Could changes in the price of cryptocurrencies impact my distribution under the plan? Ravi, can you join us to address that one?
Absolutely. Thanks, Kelly. So the short answer is yes. Changes over time, and specifically since the May 31 date of the disclosure statement, will affect the value of liquid cryptocurrency that you, the creditors, receive under the plan. So each creditor will own a pro rata share of the total available liquid cryptocurrency to be distributed. To the extent the value of that pool of available liquid cryptocurrency increases or decreases between the May 31st date and the effective date of the plan, creditor recoveries will participate in that value change, both upward or downward. To further clarify that point, any value change will not accrue to the benefit of any third parties, including Fahrenheit or NewCo. All of these changes in value of cryptocurrency will accrue to the creditors receiving liquid crypto distributions in the plan.
Well, that's pretty huge. This is what I've been saying for a while, and what I believed was the right case. So this whole 36% back in liquid crypto, this was taken as a snapshot of the date of crypto. I believe May 31st is also what he confirmed right now. If the price of crypto goes up in USD value, I should say the price of Bitcoin and Ethereum most likely goes up in USD value, then we, creditors, will get a higher percentage back of liquid crypto. Remember, percent back is just based on the US dollar value of your claim. So that's why you can get more percent back, because if Bitcoin goes up, then it's going to be worth more dollars, and then you're getting a higher percentage back. It doesn't mean you're getting more coins back. It just means that you're getting a higher US dollar amount back that will be paid out in Bitcoin and Ethereum. So a little bit confusing, but what he's saying is what I thought, and what I'm glad he's clarifying is that, again, like if Bitcoin goes to $50,000 or $40,000 at the time of the plan confirmation, then we will get back an initial distribution of more than 36% liquid crypto. So the downside, like I talked about in my last video, is that if Bitcoin rips past $60,000, and I believe Simon Dixon does have specific dollar amounts for Bitcoin and Ethereum, that if it went higher than that, we would be made completely whole. The creditors would be made whole. And if that's the case, that wouldn't be great, because then any additional benefit would go, I believe, to like the FTC and not to us. But hopefully that doesn't happen. And if it does, I'm hoping the judge does not allow that to happen, and the benefit still goes to us, the creditors.
And then we had another one on how do I elect to receive a greater distribution of liquid crypto?
Sure. The plan offers eligible holders the option to make what's called the liquid cryptocurrency weighted distribution election. I recognize that's a mouthful, but that's the defined term under the plan. Using that, eligible holders can make an election on their ballots to receive potentially a greater distribution of liquid cryptocurrency instead of all or a portion of the NewCo common stock they would otherwise be eligible to receive. Any holder that makes such an election, and to the extent it's able to be honored under the plan, will receive additional liquid cryptocurrency. It's also worth noting these elections will be honored only if the NewCo transaction is consummated ultimately.
So we also knew that as well. I've been mentioning this as well. This was in the disclosure statement. Basically, if people want to get more equity and less liquid crypto, they can get a lot more equity and less crypto. Vice versa, if some people want zero equity in this company and they want more crypto, they can do that as well.
Chris Ferraro, we had a question regarding when the liquid cryptocurrency distribution will occur. Could you comment to that?
Yeah. Look, let me start by saying we are currently developing a plan to distribute the liquid crypto in consultation with our advisors in the committee, the goal of which is to do immediately circa effective date, and to get the crypto back into the hands of you guys, the account holders. The distribution will be a combination of using the Celsius platform and partnering with a third-party provider. We will provide further analysis in an amended disclosure statement to be filed prior to the August 10th hearing.
Great, thank you. And then, Chris, while we have you, how will the U.S. and non-U.S. liquid crypto distributions be made? Do we have any answers on that?
We're still working through that and finalizing. I don't want to get in front of it, but we will have the U.S. and the non-U.S. With the goal of both going live right after the effective date.
Great, thank you. Next question, I'm going to turn this one to Steve Kokinos. Why does NewCo require 450 to 500 million in liquid crypto? Why is it needed?
Sure. And that's a question we've seen quite a bit. I think there's a few different elements, so I'll just kind of unpack that. But the first is, NewCo is going to be a scaled public company with significant revenue, on day one. And if you look at the scale of that compared to other public mining companies like Riot or Marathon Digital, the NewCo capitalization amount is intended to be quite similar and comparable to those other scale businesses. And the reason behind it is largely to provide NewCo and the board, which, just to remind everyone, will be controlled by the creditors, will have the ability to invest in mining, but as well as other opportunities that come up. But do that in a way that doesn't require financial leverage, i.e., not to borrow against it. And so what we really looked at is, what is sort of best top of the market, and how do we take best advantage of market opportunities. And an example of opportunities we might take advantage of towards efficient growth is a strategic ASIC partnership that was described in the Fahrenheit proposal. And we think that that's one example, although there will be others, of the types of initiatives that the NewCo could potentially pursue with board approval. I think it's also worth pointing out, given that everyone understands that the crypto markets are volatile, is that a strong balance sheet will also enable NewCo to better manage that volatility, including the upcoming halving, and be able to make opportunistic investments that drive enterprise value for everyone. And I think the question has arisen as to how we'll go about stewardship of that. I think the first is that we intend to stake as much of the Ethereum on balance sheet as is practical. And as part of this, as part of the project, NewCo will receive a royalty-free license to use IP that Proof Group has created to optimize Ethereum staking. And as a result, we think that we'll be able to generate materially more yield than using third parties to stake would be the case. And so, additionally, we think there's also optionality in being able to participate in new protocols, using staked ETH to provide security for new projects coming up and drive additional yield. And that's something that we'll be working closely with NOAA and Proof Group on. And again, I think when you look at the Ethereum component in the balance sheet, that is something that will be unique to public company assets that are out there today. And so we think that there's enterprise value to be driven. So I think that there's, again, a few different reasons there, but I think having optionality and having the ability to grow NewCo quickly and do that in a way that provided the board agrees, allows us to take advantage of that flexibility, will be something that maximizes enterprise value and shareholder value for everyone here.
All right, so that was a lot, but basically justifying and he may be totally right, why they need around $500 million of value to fund Fahrenheit. So basically saying that this is similar amount of funding that Marathon and Riot have, so nothing unusual there. This will also allow them to not need any leverage or less leverage. Also, having a really strong balance sheet will help manage the volatility of the 2024 halving and all that ups and downs that come from that. And also, it'll allow them to make opportunistic investments. So when there's a good deal, they can obviously invest in companies. Hopefully, that's not like what Celsius did, but anyway, that's what they said. And do things to increase enterprise value, aka make your shares and equity worth more money. So we will see. They also talk about the ability to do things with staked Ethereum and how that would be unique in a publicly traded company, which I believe is true as well.
Great. Thanks, Steve. Last question in sort of this broad bucket of liquid crypto distributions. Why are the altcoins being converted to BTC and ETH? Ravi, can you take that?
Absolutely. So as disclosed by both the debtors and the committee in a joint stipulation that they've made, the debtors have been in regular dialogue with both the SEC and certain state regulatory agencies regarding the proposed distribution of cryptocurrency under the plan to assure, of course, that all distributions are in full compliance with applicable federal and state laws and regulations. And it's in that context that the decision was made that all distributions under this plan in any of its forms would be to the extent that liquid crypto distributions are made, they would be exclusively in the form of Bitcoin and Ethereum. And again, just want to highlight that that would apply to the NewCo transaction structure as well as the managed wind down.
Great, thanks. I do know that a couple people have requested speaker. We're going to try and, again, we had over 300 questions that were submitted, so we are going to try and get through as many of those as we can and then open it for questions. The next sort of bucket where we had dozens of questions was around the NewCo assets. Ravi, could you talk to us about, the question was, what assets specifically will be transferred to NewCo?
Absolutely. Well, first, the one asset that we'd like to announce specifically today that we're going to contribute, and it comes directly from my good friend and colleague Noah Jessup at Proof Group. We're going to contribute to NewCo, and this will come from Fahrenheit, a $25 Applebee's gift card. Beyond that, the core assets that are going to come over from the creditor estate, we're going to have the Celsius mining assets, which to enumerate will be roughly 122,000 mining rigs, 4 hosted sites and related infrastructure, and that's valued per the disclosure statement at a midpoint valuation range of $565 million, the mining business we'll call it. The second group of assets will be the liquid cryptocurrency, which Steve talked about, that will be transferred to NewCo. The third group of assets, which I'd like to spend a couple minutes on because I think it's important to really understand these. And in totality, it's a little bit over $350 million of value per the May 31st disclosure statement. You've got DeFi cryptocurrency assets of about $127 million. You've got institutional loans of about $75 million. You've got private equity and venture capital investments of about $155 million. Now, what's important to realize about these 3 subgroups that, again, in total account for a little bit more than $350 million of value is these assets are presently expected to be illiquid as of the effective date. So they are not eligible for distribution. I think there's been some confusion in some of the stuff we've seen on social media around these assets. So one of the things that I would highlight in the NewCo structure is these assets will be contributed to NewCo. For people that want to participate in the upside of these assets over time, they hold NewCo equity and they shall. To the extent that people want to get liquidity for their proportional ownership in these assets, they can certainly achieve that by tapping into the liquid markets we hope to help create for the NewCo listed common equity. And so we think that's the way to properly think about that and contextualize how these assets fit into the overall plan context.
So let me just go over that. What assets will be transferred to NewCo? We have $565 million worth of mining assets. We have some liquid crypto, obviously. And the third is this $350 million from DeFi, institutional loans, private equity, and VC investments. And people with equity will be able to get the upside of these investments. Now, these are things that Celsius and Alex Mashinsky and the entire company were buying and investing in companies and doing these VC investments. And often we didn't really know that they were doing that, but they did. And these aren't that liquid because it's hard to sell, or at least right now, you'd definitely have to sell it for less than what you bought it for, because equity in general is not doing that great right now. So by transferring these assets over to the NewCo, we don't need to sell it for probably fire sale prices, and we can then still get the upside if we go into another bull market or if these companies do well. So honestly, I think that is pretty cool.
Thank you, Ravi. Next questions are around Bitcoin mining. So we're going to bring Asher up here. Asher, to get us started when it comes to NewCo's proposed Bitcoin mining operations, can you share how you think about the mining business today and also how you think about it as it's going to grow?
Sure. We believe that there's significant upside for the mining business if we're able to execute, if we're able to plug all the machines in, vertically integrate them, and really control our own destinies. If you look at two large publicly traded miners like Riot and Marathon, they're both trading around $3 billion in terms of market cap with a similar fleet to Celsius. And so that's on the mining division alone. However, the execution of 122,000 rigs and making sure all of the rigs are performing well, are all plugged in at infrastructure that's reliable is not easy. And many people in our industry have failed to scale and have failed to grow. And that's why I think US Bitcoin brings value to the Fahrenheit Group and to the new company is our historical ability to be able to scale and operate these facilities as such. The size of Celsius, that's what needs to be done, is a proven operator to be able to grow and continue to manage the business, the current fleet of the business, and continue to grow on a go-forward basis. Mining, we think, is really all relative, right? Your cost of operations to mine a Bitcoin really matters in comparison to the other miners in the ecosystem because there is a fixed amount of Bitcoin that is released by the ecosystem every single day. And you have to be more competitive than your peers, whether Bitcoin is rising in price or it's decreasing. As long as your margins are better than your peers, you'll continue to be able to be operational. So first is your cost of operations, and by vertically integrating, you're allowing your cost basis to drop. Second is your entry point of investment. And so back in 2021, when the markets were running, Bitcoin ran up to almost $70,000. Our average cost of a machine came in around $35 a terahash, which is roughly around $3,500 a machine. That relative to the market average with releases at around $60 to $80 a terahash, which is $6,000 to $8,000 a machine, so almost double. And so entry point is really important. Having strong relationships with the key manufacturers, so there's three main manufacturers in the industry, is important to leverage your capital and have a higher return and payback on that capital. And we can dive into that a little bit. I know there's a question that addresses that. And so having gone through the cycles of Bitcoin and Bitcoin mining specifically, and knowing what strategies to deploy at different times in the market will not only allow us to execute well and deploy the current fleet, but be able to continue to grow the business and continue to grow equity value.
Thanks, Asher. We do have a lot of specific questions on the mining, so bear with us. The first one, give us more color on the New York site and why the offer there is 570K megawatts versus the 395K per megawatt referenced elsewhere in the proposal. Can you speak to New York specifically?
Yeah, most definitely. As was mentioned earlier on in the spaces, we went through a long auction process. And originally, one of the values that we brought was, look, we have a site fully built in Niagara Falls, New York. And that site we can sell to the estate to be able to plug in miners and have a site vertically integrated without having to go and build, take any operational risk, and be able to deploy and hash immediately. Then there was a request on giving the new company optionality to either be able to buy or to be able to host their machines there and to be able to operate. So the 395 cap is more focused around developing a new site from the ground up, where the 575 number comes from purchasing a fully built and fully constructed site. So the Alpha facility is a 50 megawatt site that's fully constructed and operational. The market price stems from the value of immediately available infrastructure over the 6 to 12 month timeline it would take to build out a new opportunity and the opportunity cost of USBTC giving up its facility. So the hosting agreement that we've offered at this site as another option for NewCo as well is 8,500 miners to be hosted at the Alpha site instead of purchasing it to act as a stopgap until Celsius vertically integrates its own sites, in which time these miners can be moved to NewCo-owned facilities and where they control their own full cost structure. So the goal is really creating optionality for NewCo and to be able to drive the highest equity value based on the market conditions at that time.
What protections are there for NewCo if this doesn't perform, if US Bitcoin doesn't perform?
So we really wanted to walk our talk and not just give assurances that we're going to operate and we're going to be able to execute. And as such, we've put in, as a part of our bid during the auction process, penalties if we're not able to meet certain benchmarks, right? So the first is if USBTC goes over $395,000 per megawatt budget for constructing a Bitcoin mining facility for medium to low voltage, the excess will be offset by the management fees from the mining division. And so that's part one. Second is if USBTC doesn't have 100 megawatts of operational facilities within the first 12 months of approval to construct, each month that goes by until we're able to energize, that's another $1 million penalty per month that comes from the mining management fees for up to the first 6 months. And then lastly, another area we put in terms of operational excellence is our ability to provide labor and the lowest operational cost. And so if the cost, and we created a cap of $2 million per 100 megawatts, exceeds that number, then those additional costs will come out of the mining management fees as well. So the goal is really to be able to give protection to NewCo and to keep us accountable on hitting these operational metrics and truly being the lowest cost operator and one of the lowest cost miners in the space.
So I just want to pause really quick, talk a little bit about what he's saying. So he's basically going to punish himself if he does not hit certain benchmarks, which I like the idea because we're giving this US Bitcoin group a ton of money and a lot of mining equipment. So if they don't hit their benchmarks, they are going to be taking money out. I mean, honestly, it's hard because a lot of these companies are just getting a lot of value, right? So these companies are getting a ton of value in equipment and they didn't really have to work for it, right? So they're basically taking other people's assets. They're taking your Bitcoin mining, essentially, creditors. So I do like the fact that at least they are incorporating some benchmarks that they need to hit. And when, they compare it to Marathon and Riot, those two publicly traded stocks have done incredibly well. They said that they have around a $3 billion market cap, Marathon and Riot, and they have a similar infrastructure to what Celsius or what Fahrenheit would have. So they do have some big benchmarks. I think this could work, but again, I'll let you know what I think more at the end of the video.
Thanks, Asher. I think it's helpful to hear that laid out in clear English. All right, next question with respect to the 43K rigs to be moved or managed under the favorable terms, can you provide as much detail as you can regarding that?
Yeah, so right now we're working closely with the existing debtor and the UCC and the mining team that's currently there to really find a path forward to be able to energize the machines that are currently in storage and haven't been energized yet. And so the way that we've broken down the 43K rigs, it's 8,500 for the Alpha site at substantially similar terms to the hardened facility that NovaWolf put up in their bid. So there was a clear replacement there and there wasn't any loss in terms of capacity. In addition, one of our partner facilities that we manage for them under our property management business, it has 20,000 rack spaces available to be hosted at a 5-year contract with the option to either do a fixed rate hosting agreement at around 7.2 cents per kilowatt hour or variable rate based on the hash price and the volatility and hash price that's consistent with the other clients at that facility. And then the last 15,000 are various sites that are available to us through the different partners and the different hosting providers that we have in the industry at comparable and competitive market terms. So that's various structures that range from a profit share structure to fixed structures at market rates.
Next question was, can you provide more detail regarding the potential ASIC partnership?
Sure. As I mentioned, there are three main manufacturers in the industry of Bitcoin mining. And that's Bitmain, Canaan, MicroBT. And so one of those manufacturers we have been working with and contributed that as a part of our bid to be able to have a joint mining partnership. What that partnership means is that the manufacturer will contribute their newest generation machines, which right now is around 30 joules per terahash in terms of efficiency, and they will contribute them to a mining facility that we contribute to the joint venture partnership with the mining manufacturer. The structure of that partnership is, let's just say they contribute 100 megawatts of machines in year one. In year one, 30% of those machines from day one will be owned by NewCo. 70% will be hosted for the manufacturer. Then by the start of year two, that number goes up to 40% owned by NewCo and then 60% hosted for the manufacturer. And then by the start of year three, 50% owned by NewCo and 50% owned by the manufacturer. So if you really think about it, historically, when you go and build a facility, and let's just say you're building a facility for the sake of numbers, 100 megawatts, that equates to around 30 to 33,000 machines. And so you would deploy the capital for the 100 megawatts, and then you would deploy the capital for 30 to 33,000 machines. In this partnership, all we have to do is deploy the capital for 100 megawatts of infrastructure. And by the start of year three, we now own half of the 30 to 33,000 machines for free. And so that really goes to the original thesis, which is how do you deploy capital and have the highest return on the investment and have the highest payback period with these novel and unique structures to be able to compete better than the other folks in the industry. So that was the first partnership that we brought to the table, and being able to not just buy it at market prices outright at scale. The second is another one of the three manufacturers brought a $100 million coupon and credit for us to be able to apply those credits to future miner purchases up to 20% of the sales value. And so our goal with bringing in two out of the three large manufacturers in this industry show how NewCo from day one will have strategic alliances with the manufacturers that drive the majority of the production in this industry.
All right, so there's a lot of talk about mining, and for good reason, because this is going to be the primary way that equity holders receive value, right? We have mining, and then we have Ethereum staking. Ethereum staking, not super complicated. You're either staking it efficiently or effectively, or you're not. So hopefully they don't screw that one up. But mining is really where the value will come from. It's why, or one of the main reasons why investors will want to buy this equity, especially when it's a publicly traded company.
Thanks, Asher. We have a few more on Bitcoin mining specifics. So could you address the issue of the useful life of the existing fleet and also replacement rates?
Sure. The debtor's model assumes a useful life of 6 years. US Bitcoin typically uses a useful life of 4 to 5 years, which stems from the failure rates. But if a unit continues to be profitable, then repairing the unit as needed and extending its life cycle rather than replacing the units may make economical sense. So the way that we think about this, like a car, if you take care of a car, no matter how old it is, if you take care of it right and you run it properly, you're going to be able to continue to run that vehicle. And so really it comes down to the efficiency of that machine and how long will that machine continue to be efficient for. NewCo may also upgrade new machines to be more efficient for the 6-year period if there are right times in the market to be able to sell and repurchase more efficient machines. And that's a practice that US Bitcoin has done historically. And so for us, as we look at the different partnerships, the credits that the manufacturer has given us to reduce significant capital outlay, we see opportunities where we might be able to sell machines into the market and be able to tap into some of these partnerships that we're bringing to the table to have lower costs of refurbishing and upgrading the machine fleet as new machines come out into the future.
And Asher, what's the impact of the upcoming halving?
Sure. So the mining model in the disclosure statement includes some assumptions around the halving. The model projects a reduction in profitability with a gradual increase due to a decrease in the network hash rate, which stems from unprofitable miners being shut off. And so the average efficiency of the Celsius fleet is around 30 joules per terahash, which would be better efficiency than the current projected network average.
Great. Thanks, Asher. Again, I see people have requested the mic. We're going to try and get through as many questions as we can and before we open it up. So moving on from Bitcoin, we want to get to some of the core questions on ETH staking. So we're going to bring Noah up so far. Noah, why should we use Nuco for staking when we could do it ourselves? Can we eliminate the ETH staking from the plan? No one wants to miss out on price appreciation and the capabilities of paying of staking ourselves without paying someone to do it. Can you kind of talk about your vision here and how that looks for Nuco?
Yeah, leveraging our services for staking is intended to afford Nuco and all of its shareholders the benefits of economies of scale that would typically be unattainable by individual stakeholders or individual node operators. The goal of utilizing the proof group IP and our experience is to optimize the staking yield in a way that smaller participants might not otherwise be able to obtain. And so at Proof Group, we're already running hundreds of millions of dollars in our staking operation, and we intend to add to that. Oftentimes, when we compare ourselves to the retail market or to other vendors, actually, we see that our system can outperform sometimes quite consistently. Additionally, we intend to reduce Nuco's operational costs associated with staking as compared to utilizing a third-party staking provider. And we think that this could result in more cost-effective staking solution overall, which means more ETH that Nuco and account holders would own. As an entity operating at scale, I think Steve spoke to this a little bit. We may be privy to a bunch of opportunities in the restaking ecosystem that wouldn't typically be accessible to individuals or smaller groups. And so as an example is to access a new protocol that is designed to allow new chains to be built on top of Ethereum security. This is a new way of using staked ETH to provide security to new protocols and earn more from that, and something that the new board may be interested in considering down the line.
And can you talk about will the staked ETH be returned to the creditors?
So the core thing here is that the Nuco capitalization amount will be transferred to the Nuco and thus owned free and clear by all shareholders. But it's important to note that the plan is intended to provide the holders receiving Nuco common equity with maximum flexibility, for example, through a public listing on an exchange such as NASDAQ. And they can decide for themselves whether to remain investors in Nuco or sell shares immediately and monetize their interests in Nuco.
All right. So this is the part where, I don't know, I don't really love it because they are using our staked Ethereum, and he's creating a case for why, if they have enough staked Ethereum, they can do things that we as individuals could not do if we decide to stake our own Ethereum, like providing security for different chains or things like that we don't even know about. When asked if the staked Ethereum will come back to creditors, the answer is obviously no. I mean, they're using this staked Ethereum to grow the equity, right? They're using the staked Ethereum as a way to reinvest the profits or reinvest that Ethereum back into mining. So the thing that is important, though, which I do agree with, is the fact that we, the creditors, or we, the people that hold equity, do still, I believe, and correct me if I'm wrong, still kind of own this staked Ethereum, right? It's not like we're giving it away because we are the equity shareholders in this new company. But will we get that Ethereum back? I mean, the answer is no, right? The answer is no to that. So anyway, just kind of sharing what I'm thinking.
In the interest of time, moving on to some of the questions we had around venture assets. Mike, I'm going to bring you up here. What is the strategy for monetizing the illiquid assets?
Yeah, so illiquid assets are, particularly venture investments, are a relatively small percentage of the business, but they are important, and there's some great assets there. Arrington Capital, my fund, will be leading the effort on monetizing these assets. And that's both private equity and venture investments. So it's weird to say this about myself, I have decades of experience in venture investing. I'm investing my entire career from Silicon Valley had 3 venture funds before Arrington Capital, and have been exclusively focused on crypto and Web3 since 2017. So I deeply understand venture mechanics and complex deal structures, and also working with companies to help them in any way they need to help them be successful. The DeFi assets and institutional loan portfolio do include certain assets. An example is stake count, that are the subject of pending litigation. We're just not really able to talk about those assets right now. But for the balance of the illiquid assets, we'll work directly with the companies involved to assist them in any way they need. We do this all the time. Kelly, who is moderating this, was previously the chief marketing officer at Algorand, and most of her job is helping our existing companies, and she will do that with NewCo. And we'll also consult with and leverage a network of seasoned workout specialists on the illiquid loan assets.
Great. Thanks, Mike. Can you talk a little bit about the aspirations and paths you see for NewCo? Beyond what we've seen with mining and staking, what will Fahrenheit do to be profitable in the future when it comes to things that you could help with here?
Yeah, so ultimately, any decision to engage in future business activities will be up to the board of directors, which we will not control. We'll have a couple of directors, but the majority of the directors will not be people that are from our group. So they'll have to make those decisions. If they choose to engage in further investing in, say, venture, we're there to help. And also Noah, who runs Proof Group, is there to help. So, as I said before, we and I have decades of experience in this, and it's not just getting deal access and picking deals, it's also helping them once you've invested in them to succeed, and then having the depth of liquidity to continue to help them financially. And since 2017, our focus has been 100% on crypto and Web3. We are very familiar with complex deal structures, and we have complementary investment and liquid market strategies for full support. So what I mean by that is we are a hedge fund. We are part venture fund and part liquid trading. So we're very comfortable with, say, adding liquidity to DeFi protocols and assisting them in all kinds of ways that a non-hedge fund couldn't. All of the principals of Fahrenheit are investors. Every one of us are investors. And everyone brings something different to the table to assist in this. Noah and I co-invest quite often, like we are here with Celsius. He has a very different investing thesis than I do, and we work together extremely well. The diversity we bring to deals generally means if he and I agree on something, there's a very high likelihood that it's going to be a great deal. But the point is, this is not being done in isolation. We, as a fund, have since 2000 we officially closed in beginning of 2018, but we were investing into the fund in 2017. We have outperformed Bitcoin and ETH since inception. In addition to growing our fund AUM over time, that includes several market cycles. We have increased our AUM over the years. We've also distributed nearly $500 million to our investors in just profit when they've made redemptions. With regard to future opportunities, and again, this is something that the board will have to decide on, and I really have no say in what the board decides to do there. But if they choose to invest, Noah and I, Proof Group and Arrington Capital, have agreed, it's in the documents, we will share substantially all deal flow with NewCo, and we'll use commercially reasonable efforts to include NewCo in any deals of interest to them. And what that means is, if a deal we look at 10 new deals a week. If a deal happens, we're going to have an open line with Steve, who will have an open line with the board, and we will offer that deal. We will tell NewCo about that deal. And then if there's interest in investing in it, we will do our best to get them an allocation. And I think given NewCo's business, the mining, the ETH, everything else, it would be an attractive investor to a lot of companies. So I don't know which way this is going to go. I think a lot of it depends on the market and what the board wants to do. But should they choose to go down the path of future investing, we are there to help.
All right, so we just had Michael Arrington talk about illiquid investments, and he is proving his track record as a venture capitalist, saying that their fund has outperformed Bitcoin and Ethereum, I believe, since 2017, which is insane because the price of Bitcoin and Ethereum in 2017 was incredibly low, especially Ethereum, relative to the price right now. And they have paid out $500 million in profits to their investors. And also, what's good is that any future investments needs to be approved by the board of directors, which is not just like a unilateral decision from Michael Arrington.
Thanks, Mike. Super helpful context on that front. We're going to move on to, there were a couple of questions on the convenience class and convenience claims. Ravi, can we bring you back up for can you give us a quick outline on what is the convenience class?
Sure. The convenience class is for account holder claims that are greater than $10 but less than $5,000. And so the way the plan is structured, holders that fit into that grouping will receive a liquid crypto distribution. They won't receive shares in NewCo or shares in the litigation trust, so they'll receive exclusively liquid crypto, and the recovery will be the greater of 70% or the recovery percentage for general earn holders under the plan. So in the context of the disclosure statement that was recently filed, that was a 70% estimated recovery percentage. Again, all payable in liquid cryptocurrency.
Okay. And what is the convenience claim election?
The convenience claim election is something built into the plan that allows holders that have a claim that's larger than $5,000 to opt into the convenience class treatment. But by doing that, they would be irrevocably agreeing to reduce their claim to $5,000. It's completely an election that they can choose to make or not make.
So what you just said, I mentioned a while ago about people can opt into the convenience class if they are above $5,000. So this will really depend on how much they're willing to pay back in liquid crypto, meaning right now 70% back in liquid crypto. For example, if your claim is $5,500, it probably makes sense to drop into the convenience class because then you're getting 70% back in liquid crypto and not like half and half in crypto and then equity, unless you want equity, and then that's great. So there will be that option, right? If you want to drop your claim or lower your claim to $5,000, then you get a higher liquid crypto distribution, but then no equity and no shares in the, or not shares, but no interest in the litigation trust, which could bring back some money into the estate. They're the ones that would be doing retail clawbacks, which I do not agree with, but they are also going to be going after insiders like Mashinsky and others. So I'll talk more about that when we're able to actually decide on that.
And lastly, they would need to accept the plan in order to make the convenience class election. I think worth highlighting.
Great, thanks. And we're going to get to some time on timing and items, so we'll get to that a little bit later. There were also a number of questions on NewCo's equity listing. So Steve, why don't you share at a high level before we get into some of the specific questions that came in? Can you give your thoughts on what it means broadly to have NewCo be a public company and why that's important? And then we'll get into the questions from the community.
Sure. Well, I think I would kind of put this, there's sort of two main themes that I think are really important. One is that if you think about governance and sort of checks and balances and transparency, I think for everyone here, that's super important. And I just wanted to highlight that as a public company, the board has a fiduciary duty to maximize value for the shareholders. There'll be public budgets, checks and balances, and as we said, the board will be approving investment decisions and capital allocation. But it also means that there'll be annual audits, SEC compliance, quarterly reports that come out that are all audited so that everyone can have confidence in the information they're receiving. But I think more than that, kind of the separate one, which sort of dovetails on what Mike just brought up, is that we expect as a public company that NewCo will be in a unique position as one of the larger Bitcoin miners but also as a company very involved in Ethereum staking, that to see new opportunities as they come and take advantage of those potentially over time. And so I think that the company's position in the market will also help drive new opportunities over time, which shouldn't be discounted.
Great. All right. Specific questions. Where will the NewCo common stock be listed? Ravi, do you want to take that?
Absolutely. Fahrenheit intends to list NewCo's common stock on NASDAQ. We've been in discussions with NASDAQ starting during the auction process and continually subsequent to the conclusion of the auction. And I think some points to highlight about why we focused on that. You've heard us talk about some of the companies that we aim to have NewCo compared to over time. Companies like Riot and Marathon in the mining space, companies like MicroStrategy in the broader Bitcoin space. All of these companies are, of course, listed on NASDAQ. It's where the liquidity is. It's also where the traditional institutions are and are often most comfortable transacting. So over time, when we thought about where we wanted to list the equity, we wanted to list it in a place that maximized liquidity by bringing in the broadest group of investors, but also giving the asset the potential to realize its full trading valuation. And given the appropriate peer comp group, if you like, are generally listed on NASDAQ, we felt that was the right place to list the asset. And that's what we're working toward.
Do you know where the NewCo common stock will be listed, Ravi? I'm sorry. Do you know when it will be listed on an exchange?
It's presently anticipated that the listing of NewCo on NASDAQ will occur right around the time of the effective date of the plan, or as soon as practically possible. But we feel pretty good from what we know now that it will be very proximate to that.
So that's pretty cool. So most likely this will be listed on NASDAQ the moment or right around the time of the plan confirmation. So there should be some liquidity, meaning if you want to sell your equity or stock right around the time that this is confirmed. So that would actually be very good.
Effective date.
Okay. And then when will the stock be distributed to eligible account holders?
Eligible holders who are due to receive shares in NewCo will receive it before it's listed on NASDAQ under the current plan, those things will be very close together as we see it today.
And will NewCo common stock be subject to trading restrictions or any lockup periods?
This is a very important point that I want to clarify. For all of the creditor class who are receiving NewCo common stock, there will be no trading restrictions or lockups of any kind. In fact, the only group that will have lockups associated with their NewCo equity is us, Fahrenheit. So we will have lockups associated with our equity holdings, but the creditors receiving NewCo will be free and clear to do with it what they please.
So that's really important and that's really good. So we won't have any limitations on whether or not we want to sell everything immediately, for example, all of our stock, but Fahrenheit will have limitations on so they just can't dump everything on us on day one, right? So that's very good.
Will NewCo distribute dividends to the holders of NewCo common stock?
That dividend policy and capital allocation in general will be something that will ultimately be set by NewCo's board of directors. And as Steve alluded to and Mike alluded to earlier, the board of directors the majority of the board of directors will be selected by the creditors committee. So that board will make those determinations, not us unilaterally.
Okay, thanks, Ravi. We're going to move on to a couple of questions we got around NewCo governance. I think, Steve, you're best suited to answer these. Will NewCo have a board of directors? You've addressed that. Who will be appointed? Can you give us a little more context on who will be appointed to the new board?
Sure. So as currently anticipated, there'll be a 7-member board. 2 of those will be appointed by the plan sponsor. 3 would be appointed by the committee, choosing whoever they choose, and then there'd be 2 independent directors appointed by the committee, but which the plan sponsor, i.e. Fahrenheit, consents to as well.
And how long will those terms be for the board members?
Yes. So the terms of the board members will be staggered. and they'd be classified across three approximately equal classes, with each one subject to reelection each year. So 1 year terms that are staggered. Board members may be reelected at the end of their term, provided that for so long as the management agreement is in effect, the plan sponsor will have the right to its two members. So the exception of the kind of the annual term is to the plan sponsor Fahrenheit, so that we would need to nominate and select board members from our group.
Okay. And then we had a final question on, will NewCo shareholders receive updates on NewCo's financial performance?
Sure. Well, I kind of mentioned this briefly before, but NewCo will provide all common stockholders financial disclosures and transparency on an ongoing basis through filings and periodic reports. So things like Form 10-Ks and 10-Qs that are required for all public companies. And holders of NewCo common stock also be entitled to receive certain information, and will also, potentially vote on certain matters pursuant to NewCo's organizational documents. So I think, really, as is the case with any public company, all shareholders will have a broad set of rights, and will also be providing ongoing reporting, and as is consistent with compliance with all regulatory requirements.
Great. All right. And then we had a number of questions regarding the plan process, disclosure statement hearing, proposed voting timeline, solicitation process. So I'm going to bring Andrew back on to sort of give an overview on that, as well as some of the specific states. Obviously, things subject to change. But Andrew, can you lay out where we're currently at and what we know and we don't know, so people are educated on the process?
Sure. Andrew Carty, Brian Rudnick. So just to sort of level set, the Chapter 11 plan was filed on June 15th, and the disclosure statement with respect to that plan was filed on June 26th. A few weeks after that, on July 6th, the debtors filed what right now is sort of the key document that's going to sort of unlock the rest of the confirmation process, and that's the disclosure statement motion. And what that motion seeks is an order from the bankruptcy court saying that the disclosure statement contains adequate information, and debtor, you can now go out and solicit votes with respect to the plan, right? So that's one of the key purposes of the DS motion. That motion is scheduled for hearing as of now on August 10th. And to the extent that that motion is granted, the timeline that the debtors are requesting, and it's subject to potential change, but typically, other than with respect to the confirmation hearing, which we'll talk about in a second, the timeline that they're requesting is that the sort of key dates are solicitation packages would be distributed to folks by no later than August 21st. Now, the solicitation package is going to include ballots for creditors. It's going to include instructions on how to complete your ballots, instructions on how to submit your ballots, all of the information, the key information that creditors need to submit their votes with respect to the plan would be included in that package. And again, what the debtors are asking the judge to approve is approve that package, and then have the solicitation start after August 10th and be completed by August 21st. The deadline to submit your ballots that the debtors are seeking is September 18th. So, you're going to get your package, you'll get your instructions, you would complete your ballot, and the deadline to submit that would be September 18th. A few days after that, the debtors would file a tabulation report on the docket that would disclose the results of the vote. And then after that, we would go into the actual confirmation hearing. I think the original date in the DS motion for the confirmation hearing was September 29th. There was a hearing yesterday, Judge Glenn. It doesn't seem like that's going to be available for him. And so he suggested a couple of blocks of time in October. I think early to mid, and then there's a block sort of towards the latter part of October. I don't know candidly, if the debtors and the committee have decided what sort of blocks they want to take there, I assume it'll be the earlier block, which is October 2nd to 6th. But I'll defer to the advisors for the committee and the debtors if they want to address that. But that's sort of the timeline. It again, as Kelly mentioned, it is subject to potential change. The judge, might move some dates around. That's possible, but this is what the debtors have requested. And this is what, to the extent that what they've requested is approved, this is what the timeline would be.
Thanks, Andrew. Appreciate that being laid out. We also had some questions around regulatory updates and recent actions. Koenig, are you still on here? Can we bring you up to address some of those points?
Hi, it's Chris Koenig from Kirkland. Yeah, happy to. So I spoke to this in court yesterday. I'll provide a similar update today. Again, we're counseled to Celsius. So there were a bunch of actions last week by federal agencies against both Alex Mashinsky and Celsius as a corporate defendant. Celsius has been working constructively, proactively with the regulators to reach consensual resolutions that will let us get out of bankruptcy. What we're pleased to announce is that we entered into a variety of consent orders that led to no claim being asserted by the regulators against Celsius that would dilute or reduce claims to account holders. So these agreements are good news for Celsius holders. Obviously, there's a separate litigation that's going to continue between the regulators and the government against Mr. Mashinsky. But the regulators are not going, these agreements are not going to delay our timeline. They are not going to soak up value that otherwise would go to account holders. We argued to the regulators that the account holders are the victims here of these crimes and that they should be entitled to the proceeds. And so the regulators agreed not to assert large fines, claims, penalties, or the like, which of course they could have tried to do, but they agreed with us that it made the most sense. We're very far along in this bankruptcy process. We're hopefully going to be out of the bankruptcy process here towards the end of the year, that it makes sense to allow Celsius's assets to be distributed to the account holders who are the victims here. So we're pleased to be able to enter into these resolutions. We're not going to get bogged down in litigation with the regulators, and we can move on and work towards getting the disclosure statement approved, the plan confirmed, and distributions out to customers.
So it's good that they worked out a deal with the FTC and the SEC so that they don't get paid with our money. But the thing that I mentioned in my last video here is that the FTC announced a $4.7 billion settlement against the exchange, they're calling that Celsius, which will not be paid until creditors and investors have been repaid in bankruptcy proceedings. So what this means, how I see it, is that if we are made 100% whole, our USD value, then the proceeds or any increase in the price of Bitcoin and Ethereum will possibly go to the FTC. Now, I really hope I'm wrong in this. Maybe it'll go to investors. Maybe there are different classes of investors that will be paid before the FTC. But this is the fear. Again, we go into this insane bull run before the plan is confirmed. We want the plan to be confirmed and then the bull run to happen, because then we're going to get the proceeds of all of that.
Thank you. Last big area were questions regarding tax consequences of the plan. Andrew, do you want to share some thoughts here?
Yeah. Again, Andrew Carty, Brown Rudnick. So we did get a lot of questions from holders about sort of individualized tax treatment. And, unfortunately, no one involved with the plan can provide individual tax advice to creditors. We urge folks to please consult with your tax advisors with respect to, potential tax consequences of the plan treatments. The only thing I can really say beyond that is the disclosure statement does provide a discussion about certain tax scenarios and potential tax implications on sort of a general level. That's in section 12 of the disclosure statement. It's not super lengthy. I know it's a 300-page document, but there is a dedicated tax section in there. And for folks who had the tax questions, I would urge you to go to the disclosure statement, review that section, and then again, please consult with your own tax advisors on that.
Thanks, Andrew. And yeah, I know that we've posted a link to this disclosure statement, which includes at the end, a pretty lengthy presentation from the Fahrenheit team. We'll be sure to post that on Twitter. I have seen a few tweets come through during this spaces. I realize we're also up against the hour, and I know that Aaron, Keith, Tom, Scott, Andrew, you are together. If there's anything major that we missed that you think we should address, I'll open it up for you guys to flag anything briefly here at the end.
Thanks, Kelly. I don't know that you've missed anything. I would actually, for the time that we have, open it up for additional questions from creditors that are here with us now.
I'd be more than willing to ask my question if that's okay.
Yeah, go ahead.
Thank you so much for holding the spaces. Really appreciate it, guys, for the transparency piece. One of the things I did want to ask the team about is if they have an opinion on a group known as liquidated loans. Specifically, that is the group of creditors that were liquidated after the freeze, but prior to the bankruptcy. And if there's any opinion that you guys have for those creditors.
Hi, this is Andrew Carty at Brownwood and Counsel for Fahrenheit. I don't, look, I know there's a mediation going on right now between the ad hoc loan and ad hoc earn groups. I think we're all very supportive and hopeful for a settlement there. I don't think we're going to address, particular types of issues like that beyond that.
Andrew, I appreciate that. The only thing I would say about that is I do not believe liquidated loans is a part of that conversation. And that group of creditors has had little to absolutely no representation in this process. So regardless of that outcome, we would hope that please do think about those people. There's millions of dollars that were at stake where people got illegally liquidated and we've had no representation. Thank you so much. We do appreciate it. And we really appreciate the spaces.
Okay.
Temco, did you have a question there? Or Lawrence, you've been...
Yeah. Lawrence, you can go first.
This is Lawrence. Thank you, everybody, for the explanation. A lot of hopium. We've been lied and cheated and lawyered. And I think all of us are very concerned that you want $500 million to invest in the startup. You say you're going to put your own money in. That's very interesting. Are you going to backstop the $500 million? We understand Lawyers Club. We don't have very much faith in the investigative work that's been done by the paid people. Are you going to listen to the people that are disclosing all of these illegal activities to track down and recover? It's gone on long enough. Anyways, thank you very much. I look forward to your ballot.
Sure. Well, I just wanted to reiterate that, understand the concern over the liquid crypto. Again, as I said earlier, we believe strongly that, getting the company out of bankruptcy, having it be financially healthy, and having NewCo positioned to take advantage of market opportunity, and doing that as quickly as possible is very important here. I also just want to highlight for everyone that the assets of NewCo are going to be owned by all of you, and as a consequence, you'll all own your pro rata share of the assets in the company and the enterprise value that derives from that. So I just want to make sure that everyone doesn't lose sight of that fact.
So that's pretty interesting. I just want to pause and reiterate that. So yeah, we're giving them $500 million, but we own the company in that sense. So just like with the staked Ethereum, we're not just giving that to somebody in the hopes that they do well with it, right? Kind of like what we ended up doing with Celsius, where we gave them our crypto and then, it didn't work out well. This isn't really the same idea, is what he's saying. He's saying that we do still own the company because we will be the shareholders in the company.
Maybe Andrew, you could help on some of the more detailed points there.
Yeah, I just wanted to add, as it relates to potential estate claims against third parties, under the plan there is going to be a litigation trust established. That's not going to be within NewCo. It's going to be a separate entity. Creditors are going to receive beneficial interests or interests in that litigation trust, and to the extent that that litigation trust realizes any value from pursuing those claims, which we assume, they will certainly investigate the claims to the extent that there are valuable claims. My assumption is they would pursue them for the benefit of creditors, and to the extent that there's a recovery, that recovery would flow through the trust and then be distributed out to creditors through that trust mechanic. So NewCo is not going to be, pursuing litigation claims. That's not really the purpose of that aspect of the deal. But there is a structure in place under the plan that would be, potentially pursuing those claims for the benefit of creditors.
For those of us who aren't looking, like the funds were not investment funds, they were like retirement funds. They were going to buy a house soon funds. They were, I need these funds, not like YOLO going to invest in something funds, which I think is a large portion of the community. Will there be an option in the plan for us to get out, if you will, or toggle, or however you want to phrase it, to not be a long-term investor?
Yes. Well, there is an option in the plan, as we alluded to earlier, for people to make an election to receive more crypto and less NewCo equity. And then beyond that, that's one of the reasons we focused so much on the NASDAQ listing approach, and there are no lockups, so that people will be able to sell their equity if that's what they choose to do in order to achieve full liquidity beyond the litigation trust, of course, on their proceeds. And obviously they can do whatever they want with the liquid crypto that they get.
Okay, thank you. I just think that's one of the most important things because, like I said, I think a majority of the people in the community, this wasn't like random funds to them. They were like really important funds. They were convinced by Alex that this was safer than a bank, and all of the great lies that he told. And so this is very important money to people, not like future investment money. So I think that's one of the most important things I want to relay.
As Mike alluded to earlier, we hear that message loud and clear. And so it's very much been a focus of ours, which is to try and provide as much liquidity as absolutely to folks that want to, achieve it as soon as possible.
Appreciate it, guys.
All right, guys. So that is the space. Overall, I actually thought it went pretty well. And I think that, just to give a really quick overview, I think there's a lot of people that may want to opt to get full equity, honestly. I think there are people that maybe use Celsius as a investment and they want to get exposure to the Bitcoin space. And they do think that the team over at Fahrenheit with US Bitcoin Group, Proof Group, all these people, everything we heard today, they are really competent and that they can produce better returns than just having Bitcoin. Again, we know that Bitcoin miners did do incredibly well. They made higher multiples of returns over just holding Bitcoin or Ethereum. So I do think that there will be people that will toggle their entire claim to equity. They did give out some dates in August and September when we're going to get some information about voting. So I'll make sure to cover that. If you have not subscribed, make sure to do so, obviously. Other than that, guys, that's basically it. Hope you enjoyed it. And I'm really glad they put this on. So till next time, guys, talk with you soon and bye for now.